Hi, I'm Sharvita, and here's a quick overview of our group project. In part A, we start by reproducing the income statement for EcoGlow Lighting Sendirian Berhad for the year ended 31st December 2024. Then, we calculate the sales price per unit, variable and fixed cost, contribution margin and ratio, break-even point, and then the net income to sales ratio. Then in part B, we analyze five business scenarios for 2025. Scenario 1 is targeted sales strategy. Scenario 2 is price adjustment strategy. Scenario 3 is marketing and cost efficiency. Scenario 4 is product enhancement plan. And scenario 5 is sales force restructuring. And based on these, we provide a final strategy recommendation suggesting the best strategy the company should implement in 2025. And I'm presenting the income statement for EcoGlow Lighting Sendirian Berhad for the year ended 31st December 2024. The company generated a total sales revenue of 1,250,000 ringgit. Out of this, the total variable costs were 775,000 ringgit, which includes 625,000 ringgit in variables production cost and 150,000 ringgit in sales commission calculated at 12% of sales. After deducting the variable cost, the contribution margin stands at 475,000 ringgit. Next, we deduct the total fixed cost of 270,000 ringgit. This cost includes 120,000 for manufacturing overhead, 35,000 for digital marketing, 10,000 for website maintenance, 30,000 for factory rental, 60,000 for administrative salaries, and 15,000 for utilities and insurance. Finally, after all these deductions, Ecoglow Lighting earned a net profit of 205,000 ringgit for the year. That's all. Thank you.
So, Assalamualaikum and hello everyone. My name is Muhammad Afiqi Farhan bin Muhammad Khairi and my matrix number is 308663. So, my part A is to determine each of the following items for the year of 2024. So, the first one, as we can see, is sales price per unit of the product. So, how do we find it? Is sales revenue divide number of units sold. So how do we find it is 1,250,000 ringgit divide 50,000 units. So sales price per unit is 25 ringgit. So the second one is total variable cost. Variable production cost plus sales commission is 625,000 ringgit plus 150,000 ringgit. So total variable cost will be 775,000 ringgit. So the third one is variable cost per unit. Total variable cost divide number of units sold will be 775,000 ringgit divide 50,000 units. So variable cost per unit will be 15 ringgit and 50 cents. So the fourth one is variable cost COGS to sales price per ratio. How do we find it is variable cost per unit divide sales price per unit. So 625,000 ringgit divide 50,000 units will be per unit 15 ringgit and 50 cents. So to find the ratio is 12 ringgit and 50 cents divide 25 ringgit times 100. So the total price ratio will be 50%. So the last one is total fixed cost. So to sum up of all the fixed cost items is the first one, fixed manufacturing overheads 120 ringgit, and the second one is digital marketing 35,000 ringgit, and websites maintenance will be 10,000 ringgit, and the fourth one, factory rental, will be 30,000 ringgit, and the fifth one is administrative salaries will be 60,000 ringgit, and the last one is utilities and insurance will be 15,000 ringgit. So the total of all the fixed cost items will be 270,000 ringgit. So that's all for me. Thank you.
Assalamualaikum and hi doctor. My name is Nuruddin Atira binti Zakarani. My metric number is 30925. So let's look at EcoGlow lighting performance based on key cost volume profit figures from 2024. The contribution margin per unit was RM9.50, calculated from the selling price of RM25 minus variable cost of 15.50. The contribution margin ratio was 38%, meaning that 38% of every ringgit in sale goes toward covering fixed costs and profit. To break even, EcoGlow needed to sell 28,000 units or RM7,000 worth of product. Finally, the net income to sales ratio was 16.4%, showing that strong profitability with 1.25 million in sales and 2005 net profit. The company demonstrated effective cost control and healthy margins. These figures are crucial for strategic planning and financial decision making moving into 2025.
Okay, so in scenario 1, EcoGlow aims to achieve a 28% net income to sales ratio in 2025 despite a 4% raw material cost increase. Using a cost volume profits analysis, we adjust the variable cost to 16 ringgit per unit, which is included the 13 ringgit productions and 3 ringgit of commissions, while holding the fixed cost of the 2700,000. Solving the equations, 0.28 times 25Q equal to 25Q minus 16Q minus 2700,000. We determine the company must sell at least 135,000 for the trippings 2024 volumes to generate a 3.375 million in revenue. So while this meet the targets, it risks losing price-sensitive customer in a competitive market. For scenario 2, where the sales volume cannot exceed 50,000 units, we adjusted the price instead by solving for the new price while accounting for the variable costs and fixed expenses. We found EcoGlow must increase its selling price to 30 ringgit and 67 per unit. While this meet the targets, it risks losing the price-sensitive customer in a competitive market. The pressure of the competitive market. The industry standard is already higher than its current price, which is 25 ringgit, increased by 22.68% can push the customer toward the low-price competitors. And demand elasticity, consumer can view the product as too expensive to buy and produce less sales than 50,000 units. And brand reputation, the EcoGlow is marketed as the company that is eco-friendly. The increase in price may offend environmental-friendly clients who want the affordable price. And next is about the feasibility, the short-term viability. No, the rate of the increase in price is very vigorous in all competitive markets. And last one is the alternative approach. Include the small price changes, for example, of 5 to 10%, and cost efficiencies measure to offset the part of the 28% target gap.
Scenario 3 is focused on marketing and cost savings. The company increased the price to 28 ringgit and expects to double its sales. Even though the sales commission and raw material costs go up, the fixed costs are reduced by 30%. Here is the income calculation for the scenario 3, and the company earns 2.8 million in sales and has a net income of 863,000. So the net income to sales ratio is 30.82%, which means this strategy meets and exceeds the 28% of target. Scenario 4 is focused on upgrading the product with smart home features. The company expects a 150% increase in sales, but the product will cost more to make and the marketing expenses also go up. So in this scenario, even with higher sales, the increased cost reduce profits. The net income to sales ratio is only 22.02%, which is below the target of 28%.
Assalamualaikum and good day everyone. Today I will present scenario 5, sales force restructuring and our team final strategy recommendation for EcoGlow Lighting Sdn Bhd. In this scenario, the company is evaluating two options to boost sales. Option A, increase commission for sale agent from 12% to 80%, which is expected to raise sales by 15%. Option B is replace agent with 8 in-house sales staff, each earning RM 1,700 monthly plus 4% commission. This is projected to increase sale by 17%. Let's look at the cost and profit impact for both option. Option A, sale agent commission increase. Total units sold is 75,000. Revenue is RM 1.875 million. Total cost is RM 1.582 millions. Net profit is 2,092,500. Net income to sale ratio is 15.6%. Option B is in-house sales team. The first is total units sold is 85,000. Revenue is RM 1.125 million. Total cost is RM 1.623 millions. Net profit is RM 501,800. Net income to sale ratio is 23.6%. It is clear that option B given higher profit and better margin. It also more cost stable long term. Let's move to the final strategy recommendation. Based on the CVP analysis, our team strongly recommend option B. This strategy offer higher profit, better control over to sale process and long-term cost efficiency. In addition, we recommend two option strategy, which is the first is product enhancement to add smart home features to eco bright bulbs to attract new market and justify premium pricing. And the second is a digital marketing investment to use data-driven ad and SEO to expand brand reach and improve lead conversion cost efficiency. In conclusion, combination in-house sale product innovation and target marketing will not only improve profitability but also strengthen the EcoGlow competitiveness in LED lighting market. That's all from me. Thank you.